Industry executives, as a part of the CII representation, met the finance minister today and sought a relaxation on the budget announcement of taxing income from high-value life insurance policies. If you've been following the stocks of life insurance companies, the story is quite clear. Their shares have slumped since the budget. But today we're looking at what such policies mean for buyers. Should you buy them before 31st March? Because the new rules come into effect on April 1st, and it's quite clear that agents of these companies and banks will be very keen to push those policies onto consumers and buyers. That's what we're also going to look at today. But before that, let me go across to my colleague Anurag Shah, who gives us the latest details of what was discussed between the industry body and the finance ministry.
Life insurance company through industry bodies has requested the finance ministry to tweak the limit announced in union budget. In union budget, government has announced that if aggregate insurance premium is paid more than 5 lakh, then the maturity amount would be taxed for non-linked policy, for traditional policies. So in this regard only, life insurance companies has requested government to increase the limit from 5 lakh rupees per year to 10 lakh, because most of the companies offer insurance policies from 3 lakh rupees to 7 to 8 lakh rupees. So companies want this limit to be increased, otherwise their revenues will be impacted, their premium will be impacted, because most of the companies think that they offer the traditional plan in the range of 5 lakh rupees. Apart from that, companies also want a clarification regarding the GST amount. Companies want clarification that in the 5 lakh limit the GST is included or it's excluded. So life insurance companies have submitted a request to finance ministry to extend the limit of 5 lakh to 10 lakh as announced in the union budget.
Now, Nilesh Sathe, former member of IRDA, is joining me on the show. I'm also speaking with Harshvardhan Rungta, CFP, and Anil Rego, founder and CEO of Right Horizons. Welcome to all of you, and thank you so much for speaking with us today on the show. Mr. Rungta, let me begin with your take on this announcement and the impact really for those who wanted to invest in it. The purpose of this, according to the finance ministry, is to remove the arbitrage the super rich were enjoying and were using it as a method to evade taxation. Was this really popular in that category, this product?
Yes, Tamanna. Yeah. So, Tamanna, it is true that there was an abnormality in the taxation on an investment product, which is categorized as the endowment plan, the traditional non-linked plans that we're talking about. So, if a person invested an amount in this policy, so this is treated more as an investment, less as an insurance. So, the premiums would be, say, probably 5 lakhs, and the coverage would be 10 times of the premium that you pay, at least 10 times. Now, if you look at it over a period of 10, 20, or 30 years, the long-term policies that are there, all the gains that you made out of these policies were tax exempt under Section 1010D. Now, the unit-linked policies, the rules have already come out a couple of years ago, wherein they said that if the premium was above 2.5 lakhs, then it was anyways going to be taxed. Now, this was very much necessary because it brings, the removal of this, tax exempted status brings it at par with other investment options. So, I think it's a very, very good move. And in fact, the finance ministry has been careful enough to understand that the lower strata of the economy, I mean, you're talking about tier 2, tier 3 cities. If you're looking at normal savers, they would certainly not go investing about 5 lakhs in a year. So all those people up to 5 lakhs, they're anyways protected, and all the gains that they make on investments or premiums rather less than 5 lakhs will continue to be exempted under Section 1010D. So I think it's a clear tax arbitrage that the super rich were trying to benefit out of. One important point that needs to be kept in mind, it's a 5 lakh aggregate in a year. So you could take a policy of 1 lakh across 7 insurance companies. So your premium would be 7 lakhs per annum. It will be taken on an aggregate basis because the aggregation is going to happen with PAN number being common. So it is not that you can take 1 lakh worth of policy from 7 companies. It is an aggregate premium that you pay per annum.
Nilesh Sathe, I want to understand why insurance companies are so worried right now and pushing for some kind of a relaxation. Reportedly, they want this amount, this number to be increased from 5 lakh rupees to 10 lakh rupees annually. And the impact that they see on their profitability or how much insurance they sell is between 5 to 7%. Why the pain over there?
Yeah, it's obvious that there will be pain because the number of policies where premium exceeds 5 lakh is quite large. And then going forward from 1st April 23, if there is not going to be EEE, as we call it, exempt, means the maturity will be taxed. In that case, obviously, those who want to pay more than 5 lakh of premium per annum, they will refrain from coming to insurance. One thing probably which is missed out by the government is no two products can be comparable. You cannot compare mutual fund with insurance. In case of insurance, 50% of your investable fund of the insurance company has necessarily to be invested in government securities. Obviously, they cannot generate so much of return as mutual funds can. You have got a restriction on investment. And this money which is invested in government securities is directly going for the benefit of the nation in infrastructure building. So this is one point which probably the government has missed. That why do you then have a restriction on investments? Make it free, and then have this. One more point is the statement that it is an instrument for evasion of tax is not acceptable. If there are certain rules and somebody is investing within those rules, it can be called as tax planning and not tax evasion. This is one word which has been improperly used, in my opinion, by the finance ministry. And again, going forward, if more than 5 lakh is going to attract tax, people will not invest. So where is the question of tax evasion? I think this is something which is these are the 2 points.
No one's saying, they're not saying it's tax evasion. It was being used as an unfair advantage, is what the finance ministry thinks. That's why they have sort of cut the cord there. Now the question is, why should insurance companies cry about it? Because their job is to sell insurance, not investments. But Anil Rigo, for the last several years, the gravy train seems to be in selling insurance policies which also give you returns. And frankly, the hyper sort of attempts to pitch these 5 lakh rupee or higher insurance premium policies has increased massively in the last few days. I have experienced it. I know of people who've experienced it. So they're all making a beeline to make, telling you that do this before the 31st of March and then you will have a great sort of return. I want to understand, Mr. Rego, is this a great policy? Is this a good idea, first of all, from an investor's point of view? Yeah.
Yeah, so if I look at it as an investor's point of view, and I think maybe even you yourself, if you have an opportunity which is legally available and you are able to achieve a certain objective within the regulations, I think definitely, you would end up using it. Yes, it has been used. There's no question about it. It has been used by high net worth individuals. I've known of people, who've taken more than 1 crore of rupees in premium, etc. So definitely there is concern from the government in terms of tax leakage. But I think from an investor standpoint, just look at it from the ability to say take care of your pension, right? And in a period where interest rates are likely to go down, right? So there are some of the guaranteed return plans which say offer you anywhere between 6.5% to 7%, which on a pre-tax basis is almost 9.5 and higher depending on your tax bracket. So I think it's something that the good thing is the finance minister has not closed it completely. I also agree you have to balance both tax considerations and ensure that the general public are able to use avenues there.
What are you saying? That if you have the window, yeah, and there is a window right now, you're saying you should go in for it? It's a good idea.
I think it is a good idea because what we like for you have to be specific on what objective you're trying to satisfy as an investor, right? For example, on the debt side, I think the guaranteed return type of plans, which give you, that type of post-tax returns, and almost like for some plans it's over 35 years, right? And my view is I expect interest rates to go down as India becomes more and more of a developed economy. Right. So as an investor, yes, it protects me from, a fall in interest rates. Right. So within the limits that I think I need to have something from a monthly income. Don't overdo it because it has its lock-in, it has its disadvantages. But I think as part of your portfolio, to ensure that you have a long-term, stable monthly income, it may not be a bad option for you to look at, especially if you're in a higher tax bracket and you're looking on the debt side. On the, let's say, the unit link side, etc., I think there are comparable options, so it's not too much of a problem. But this side, I think
I want to
there
get
is a lack of
Harshvardhan
options for
Rungta's
the
view
investors.
on this. Harshvardhan Rungta, just from an investment point of view, do you think it's a good idea to take it because some of these schemes seem to have an abysmally low return?
Yeah, so Tamanna, in fact, I'm on that side of the fence where I believe that investments and insurance should be segregated. Okay, if you look at pure investment strategies, I mean, you would find definitely higher yielding products. I mean, not in the terms of returns in percentage points as coupon payments, but you will have enough opportunities to invest for your retirement of monthly cash flows. NPS is just one such example where you can plan your annuities and retirements. Though it is not strictly comparable to what we're talking about, but they're far, better, efficient products. If you look at endowment plans, the way they are structured, I have serious objections on the part that they have, lock in. And if you want to surrender your policy within the period in which you're making the premium payments, you tend to get even lesser than what you've paid. So it's a very high cost, high commission based product, and it is not in the interest of investors per se. Now, having said this, you must also understand the finance ministry has understood the insurance element of it and has said that even those policies where premiums are in excess of 5 lakhs, in case of death, the death benefit that the nominee receives is not going to be taxed. So it's only the investment part that they have an issue with, which I completely concur with. And insurance, in fact, Tamanna, has been the most missold product in this country. I mean, the kind of targets that have been given to your bank relationship managers, they, just kind of anybody who walks in, even to make a fixed deposit, be it senior citizen, be it anybody who understands not. I mean, they're simply asking them to buy insurance policies, which is kind of a issue, and it is not a wealth creation tool for sure. So I have my concerns on, and now as you rightly said, I mean, they're on a spree now that 31st March is the deadline, and just go about buying it. I think every person that we know of would have been contacted by an insurance advisor to say that this is the last opportunity to buy into tax-free product. So I think this speaks for itself. Insurance is insurance. Keep it separate. Buy a plain nice term plan. Investment, there are lots of avenues which are more flexible, cost efficient, without the restriction of high surrender values to give your own money back to you. One more element, if I have the time, Tamanna, if you permit, I mean, I'd like to highlight the opaque manner in which insurance companies function, especially when it comes to giving money back to people, their own money if the policy was to be surrendered, especially life insurance, private life insurance companies. And we have a member from IRDA here, so I believe that he would also take cognizance of this. If a person wants to surrender his policy, I know of private companies which insist that the policyholder comes himself or herself to the branch in working hours to surrender. When I bought the policy, I did not visit the branch, right? Now, if I
Right.
want to surrender it, so these are a couple of things which
No,
I
but
think
that is a very valid point. When they want to sell you the policy, they will track you down no matter where you are at your time and convenience. When you want to surrender the policy, the whole tone and tonality changes. Nilesh Sathe, is it time that the insurance sector is weaned off this insurance plus investment mantra? There are concerns of misselling, and it also becomes lazy marketing. You're just trying to target a few people who will give a higher premium rather than actually increasing the penetration of insurance in this country, which is a real concrete need.
Okay. A couple of points which Mr. Rumta has said. One is, it is not an efficient instrument of investment. I fully agree with you. The reason being, if you ask insurance companies to invest 50% of your investable funds in government securities, which obviously do not give market-related return, how this can be tax efficient instrument? How this can be efficient instrument for investment? Definitely not. That is the reason why tax relief has been given, that bonus will not be taxed. And this money which is invested is ultimately used by the government only. So this is one part. It is certainly not a tax efficient interest efficient investment or yield efficient investment, but still people want to invest only because there is a tax exemption related to it. So this is one part. Second is misselling. People have been talking about misselling. Misselling, I don't deny that misselling is not there. It will definitely be there because every salesman would like to push his product. And how many salesmen do we have? There are 24 lakh life insurance agents, while for mutual fund, although it is so efficient product, they don't have even 1 lakh active agents. There will be hardly any pin code where you don't find a policyholder. While in case of mutual fund, why is it that 60% of the total collection comes only from 5 big cities? Now to
Sir,
have a spread.
no, but what is the point you're trying to make with that data?
I only want to make a point that those who do not have avenues for investment or who do not find where do we invest money, there is an insurance agent who gives him guidance for investment, and it is well spread. While in case of other avenues, they are not well spread. And when people realize that this is not an efficient way of investment, they will move to mutual fund.
Are they realizing? The question is, are they realizing, and will this sort of push it forward? Let me ask you just one question, Mr. Sathe. Do you think that the industry should fight this and ask for, some kind of easing here, or should they now refocus, knowing that they need to sell a product even if it doesn't have the buffer of giving tax exemptions?
Tamanna, they have been modest in asking finance minister to increase it to 10 lakhs. In my opinion, they should be removed altogether. What is the problem? People are not evading tax. Word use is not arbitrage. Word use is evading tax. This is a tax planning act, not tax evasion. And if people find that the net income that I am getting out of policy is less than the amount which I may get in investing somewhere else, why they will invest? It's not that people who are investing more than 5 lakhs are fools or 10 lakhs are fools. On the contrary, they know much more than you and me. They know the importance of how to increase their money. And if they're misselling has to be curbed. It goes without saying.
Right. I don't know. The thing about misselling and those charges of misselling is it's difficult to pinpoint, and it's too hard to track down once it's happened. It becomes a lot of he says, she says. So it's a bit of a tricky terrain there.
Right.
But anyway, for the insurance sector, they're going to have to find products that stand on their own merit and not because of the crutch of tax exemption. For you as an individual, if you are being suggested to buy any of these policies, check first if it actually works for you. Just because there is a last date looming doesn't mean you sign on that dotted line. Thank you to all of you for joining us on the first discussion this evening on the India Development Debate. The IT sector is in focus again.